Have you ever walked into a bank for a loan and wondered, what's in it for them? It's a simple question, but the answer reveals the entire business model of banking. Let's look at Anna. Her car broke down. She needed money, and she needed it fast, so she walked into that big, official-looking bank building. The person behind the counter was friendly, offering a solution that seemed so easy. Anna felt a sense of relief wash over her. She was getting the help she needed to get back on the road. But this moment of relief is where the bank's profit machine whirs to life. The bank isn't a charity, it's a business, and a very profitable one at that. When they handed Anna the money for her car repair, they weren't just doing a good deed, they were making a calculated investment. Anna, in return, made a promise. She signed a contract, agreeing to pay back every single dollar. But she also agreed to pay back more than she borrowed. This extra money is the entire reason the bank exists. It's the price you pay for using their money instead of your own. Understanding this is the first step to taking control of your financial life. People get into trouble when they only focus on the monthly payment. They ask, "Can I afford this payment?" Instead ask, "How much is this loan really costing me?" Anna was offered a loan and the monthly payment seemed manageable. What she didn't immediately calculate was the total cost over the life of the loan. That friendly teller and that comfortable office are all paid for by the difference between the money they lend out and the money that comes back in. This difference is where your wealth is transferred to their balance sheet. It's a slow, steady drain that many people don't even notice. It starts with a need: a broken down car, a leaky roof, a medical bill. The bank presents itself as the hero, the rescuer in a time of crisis. But let's be very clear, the bank is a business selling a product. That product is debt. And like any product, it comes with a price tag. The problem is, that price tag is often written in fine print. Percentages fees that sound small but add up to a mountain of money over time. The bank is betting that you won't do the math. Your job is to prove them wrong. So, how does the bank actually make its money? The primary way is through something called interest. Interest is simply a fee for renting money. Think of it like this. If you rent an apartment, you pay the landlord every month. When you borrow money, you pay the bank interest. Let's use a simple example. The bank gives Anna a $1,000 loan for her car. They set an interest rate of 5% per year. In 1 year, Anna pays the bank an extra $50 for using their money. That $50 is pure income for the bank. But interest isn't all. Banks are masters of fees. There's often an origination fee or an application fee just to set up the loan. In Anna's case, this might have been a flat $20. Then, if she were to miss a payment, even by 1 day, she'd get hit with a late fee. These fees might seem like small potatoes, $25 or $35 here and there. But I want you to think about how many customers that bank has. Multiply those small fees by thousands of borrowers. Multiply them by millions of borrowers. You're talking about a ton of money. Now, you have to understand where the bank gets its money in the first place. They don't have a magical money tree in the back. They get it from you. Deposits in savings and checking accounts. They might pay those depositors a tiny bit of interest, say 1%. Then they turn around and lend that same money to Anna at 5%. The difference between the rate they pay out and the rate they charge is their profit margin. This is called the net interest spread. In our example, the spread is 4%, 5% minus 1%. It's a simple, brilliant business model. Borrow low, lend high. That spread funds the bank's entire operation. It pays for the fancy buildings, the electricity, the computer systems, and the salaries of every employee, the teller, to the CEO. So when Anna pays her interest, she's not just paying for her loan, she's helping to fund the entire institution. The wider that spread, the more profitable the bank. Your goal as a borrower is to get the lowest rate possible to shrink their spread. The bank's goal is the exact opposite. It's a financial tug-of-war, and the person with the most knowledge usually wins. A bank doesn't just hand out money to anyone who asks. They are in the business of managing risk. Before they ever approved Anna's loan, they did their homework on her. They pulled her credit report. They looked at her credit score. A credit score is just a number that tells lenders how likely you are to pay back your debts. It's your financial report card. If Anna had a history of paying her bills on time, she would have a high score. That makes her a low-risk borrower. The bank might offer her a better interest rate because they're confident they'll get their money back. Now, what if Anna had a low credit score? A history of late payments or unpaid debts makes her high risk. The bank might deny her loan application, or they might approve it but charge a much higher interest rate, 10%, 15%, instead of 5%. The bank charges more to compensate for the risk. They bet that interest from paying borrowers will cover losses from defaults. Many loans are now processed online. Algorithms can make decisions in minutes. Computers have made lending faster and cheaper for banks. That increases their profit margins. Sometimes, after giving Anna a loan, the bank sells that loan to another company. This is called securitization. The bank gets a lump sum of cash right away. A new company takes over collecting Anna's monthly payments. Anna just sends her payment to a different address. For the bank, it's a way to make money quickly and reduce long-term risk. They collect the initial fees, they make a profit on the sale, and they move on to the next customer. It's a high-speed version of the old lending model. So let's bring it all back to Anna and her simple car loan. She walked in needing help and walked out with debt. She agreed to a loan with a 5% interest rate and a $20 setup fee. As long as she made every single payment on time, the bank would collect its interest and its fee. After the bank paid its own costs, like the 1% interest to its depositors and its operational expenses, the rest was pure profit. If Anna had slipped up and paid late, the bank would have collected even more money in the form of a late fee, padding its profits further. Every part of the process is designed to make the bank money. The bottom line is this, folks. Banks make money from you in three main ways. First, they charge you interest, the fee for renting their money. Second, they pile on all sorts of fees, starting the loan, paying it late. Third, they profit from the spread, the difference between low rates paid to depositors and high rates charged to borrowers like you. They use credit checks and technology to manage risk. They sometimes sell your loan to other companies to make a quick profit and do it all over again. This isn't complicated. Anna borrowed money, she paid interest, she paid a fee. The bank used her payments to cover its own, much lower costs and kept the difference. That is the fundamental story of how a bank profits from your loan. The system is set up to benefit the lender, not the borrower. The bank is counting on you to be emotional and desperate, to focus only on the immediate problem and not on the long-term cost. They are hoping you don't understand the game you're playing. The lesson here is simple. You need to have a plan for your money. Live on a budget, save up for purchases, avoid debt. You take the power back. You stop making banks rich and start building your own wealth. Borrowing should be your last resort, not your first option. Anna's story shows how small parts, a little interest, a small fee, add up to big profits for the bank. When you borrow, you are paying for more than just the money. The bank's building, their salaries, their shareholders' profits. Remember that the next time you think about taking out a loan,